The headlines we are tracking for you this evening. Homegrown venture fund Blume Ventures has announced the closing of its Fund 4 at over $250 million, bringing the firm's assets under management to over $600 million. Blume focuses on early-stage, innovative technology-led startups and backs entrepreneurs either building to solve large, impactful Indian problems or taking the best of Indian innovation to global markets. To talk to us about plans with Fund 4 and the road ahead at Blume Ventures, joining us now is its partner, Ashish Fafadia, and my colleague Ritu. Ashish, welcome to Startup Street. This is your biggest fund. What is the kind of impact you hope to create? How many startups are you looking to invest in? And what will the ticket sizes be? Also, how much of this will be deployed in your existing portfolios? Are you looking to support companies in their growth stage as well?
Thank you. Appreciate for having me over. Thank you very much. So the questions that you asked about the approach. So yes, this is our largest fund, and the intent is to continue investing with the approach of early stage investments, which are pre-series A and seed investments. The intent is to be the first institutional investor on the cap table of the company. And the check sizes will continue to be in the range of about $1 million to $3 million. Given the size of the fund, we have also created the ability for ourselves to be able to come onto certain cap tables and work with very high quality founders in case there is a slightly higher requirement of potential investment as well. And the idea here continues to be focused on fresh early stage businesses, which means that we are definitely not meaning to use this corpus for our existing portfolio. Those are some things that we do by virtue of our opportunity funds. This is meant to be our core strategy. And the idea is to go deeper into the ecosystem with 30 to 35 fresh investments over the next 2.5 to 3 years.
All right. Okay. Ashish, there is an overall gloom around fundraising and liquidity globally. But this year, we've seen VCs raise a lot of money. There is a lot of dry powder sitting on the sidelines. We're seeing early stage companies raising large rounds versus companies in growth stages. As profitability has become one of the key deciding factors for startups. But how do you see this playing out?
There is a fair bit of interest when it comes to the VC space. And you're right, we are talking about a fairly strong undercurrent where people are focusing around businesses which can be built more efficiently and talks around profitability. Having said that, we're also in the midst of an environment where if there is a real merit in a business and the business model is looking to be clear, there is definitely a lot of scope and interest coming on. So while we're in the midst of a fairly talks around winter, etc., we continue to see a fair bit of momentum. And all through the last 12 months that we have been fundraising, the intent of people looking at the space was to understand India more and look at this as the sector and space over the next 10 to 25 years. And that has resulted into a fair bit of allocation towards India. Not only the overall allocation towards India funds, but a carve out in global funds towards India pools as well.
Ashish, this is Ritu. You referred to some of that funding winter. What we're seeing is an ongoing round of layoffs, restructuring, or worse, some even shuttering businesses. How have the companies in your own portfolio performed? Are some of them very severely impacted? And also, if you could tell us, while some of them are not able to access equity in the market, are they resorting to raising debt for the time being?
So, Ritu, it's a very relevant question. We recently concluded an overall analysis of assessment of risk in our portfolio given the current climate. And we have gone through 95% plus of our mark to market across all the funds. And the results were that the companies are in a reasonably good shape. What we are seeing as layoffs, etc., is the endeavor of these companies, whether in the portfolio or outside, to move towards a more efficient growth. There was a very high degree of momentum, and I don't think we can shy away from the fact that enough and more companies that raised money over the last year in 2021 did go around buying growth. That whole tendency of buying growth is something that had to be really stopped. And that is where we are seeing a fair bit of consolidation where companies are trying to prioritize on the core areas of business and focus on growth. And here, the motivations of the board and the founders are pretty clear. The mandate is that rather than buying growth and clocking 100% or 80%, it's okay to be sustainably growing in the range of about 40 to 50%, because the base effect in many companies in the Indian ecosystem, we have 100 plus unicorns in the country. And at that scale, it is perfectly fine to be tapering down, but one needs to be burning much lesser and have a path to profitability. Because at the end of the day, the test of the company is going to be public. And that's what we are working with our founders as well. The team has expanded, and we are focusing on making sure that there is bandwidth and energy towards the growth portfolio in the firm to see a few companies go out there and list and test the capital markets on the bourses, because that's the ultimate test, and that's what you want to be able to scale.
Okay, so that is my next question. We run out of time. So very quickly, Ashish, are some of your exits getting delayed because of the current environment? Have you had to reconsider your exit strategy? If not, how many exits are you eyeing in the next 6 to 12 months?
So we did exit 2 companies over the last 3 months, and there are 2 more coming up. So broadly, yes, there is definitely a delay in the exits. I'm not going to underplay that. But overall, things are on track with that marginal quarter or 2 of delay.
All right, Ashish, we've completely run out of time, but many thanks for joining us on the show and wish you the very best with your Fund 4.
Thank you. Thanks, Ritu.
And speaking of investments, let's see how the startup space fared in terms of new deals this week. 15 deals took place, valued at over $93 million. Some notable deals include D2C beauty brand Rene Cosmetics backed $25 million from Evolvescence India, Edelweiss Private Equity, and others. Now, parking solutions provider Park Plus raised $16 million from Epic Capital, Matrix Partners India, and Sequoia Capital India. Unicus got $12.5 million from Nexus Venture Partners and others. That's not all. Fashion platform Virgio raised $10 million from Process Ventures, and EdTech startup Virohan got $7 million from Blume Ventures, Rianta Capital, and others. Overall, the startup world has seen 1,092 deals this year so far, valued at over $23.3 billion.
All right, more than 1,000 deals this year already, Arundhati. But on that note, we're going to head into a short break. But stay with us, because up next is a special report on FMCG major HUL and its latest acquisition of a D2C brand. We'll tell you about that and more when we return.